All right, let's get right to it. The single biggest mistake investors are making in the Sri Lankan market right now is valuing companies based on stuff they can physically touch. It's a completely flawed strategy, and today, we're going to show you exactly why it's costing you money. And I really want you to let that sink in. Because if your entire investment strategy is based on physical assets, you're not investing in a living, breathing business. You're literally betting on the company failing so you can sell it off for parts. That's not investing. So, at the heart of this flawed thinking is what people call the replacement cost fallacy. It's this belief that a company's real worth is just the sum of its desks, chairs, and buildings. This is the liquidation value myth, and I promise you, it's the fastest way to misunderstand where the real value is in today's economy. Okay, let's make this crystal clear. While all the amateur investors are busy trying to calculate the scrap value of office furniture, the smart money, well, they're looking for something totally different. They're not looking at the hardware, they are analyzing the software. The real value is in the code that turns a company into a cash flow machine. And you know what's crazy? The map to finding this code has been hiding in plain sight the whole time. It's called LKAS 38, the official accounting standard for intangible assets. Now, don't let the name put you to sleep. This isn't just some boring rule. It is the treasure map to a company's secret sauce. So what is this secret sauce actually made of? We're talking about stuff like acquired goodwill, the company's digital nervous system, its software and licenses, and the legal armor of its rights and franchises. This isn't just air on a balance sheet. No way. This is the operating system that makes the business run and absolutely crush its competition. But here's the catch. There's an accounting trap. The rules we have right now actually punish the most innovative companies. When a company invests a ton of money in R&D or building its brand, the very things that create future value, it has to expense those costs immediately. This makes them look less profitable on paper than some boring company that isn't building anything for the future. And this brings us to the million-dollar question, right? With all this going on, how do you, the investor, tell the difference between a truly dominant company with a deep competitive advantage and one that's just using accounting gimmicks to hide its losses? How do you spot the difference? Look, I'm going to be direct. Most investors will get this wrong, and they will lose money. If you want to be the one who profits from their mistakes, hit that subscribe button, because I'm about to give you the cheat code. Okay, here it is. This simple filter is all you're going to need. You look at two things. If a company has high intangibles and high or growing profits, you're almost certainly looking at a real competitive moat. But if it has high intangibles and its revenue and profits are low or even declining, that is a massive red flag. That's a company hiding its problems. And this is exactly why this matters. That second scenario points directly to something called impairment risk. You should think of it as an accounting time bomb that management has planted on the balance sheet just hoping you won't notice. But eventually, that bomb has to go off. The value gets written down, and the stock price gets absolutely crushed. Our cheat code helps you hear it ticking. So the final principle here is this. A huge number 4 intangible assets on a balance sheet isn't automatically a bad thing. Don't fear the number. What you should fear is a management team that can't explain it. If they can tell you precisely how that software or that license or that brand generates cold, hard cash, that's the ultimate sign of a high-quality, smart leadership team. And this is the new reality. Just think about it for a second. You can't build 1 million factories overnight, but you can sell 1 million software licenses. Intangible assets are the only assets that can scale almost infinitely at virtually zero extra cost. The investors who truly grasp this fundamental principle, well, they won't just participate in the future of the Sri Lankan market, they are going to own it.